Let me tell you something that might change everything. You think you know about retirement income. If someone handed me $250,000 today and told me I needed to generate $80,000 per year in income, most financial advisors would say it cannot be done. They would tell you that is a 32% annual return. They would say you are dreaming. They would say go back to work. But here is what those advisors do not understand. There is a fundamental difference between investment returns and income generation. And if you know the strategies I am about to share with you, if you understand how money really works, you can absolutely generate that level of income from a $250,000 nest egg. I have spent over 70 years studying how to make money work harder than the person who owns it. And today, I am going to show you exactly how I would approach this challenge if I were starting over at 60 years old with $250,000 and needed serious income to live on. Now, before I get into the specific strategies, let me tell you a story that shaped how I think about income investing. Back in 1962, I met a retired railroad worker in Omaha named Harold. Harold had worked for 40 years, saved diligently, and retired with what seemed like a comfortable nest egg at the time, about $200,000. His financial advisor put him in a portfolio of blue chip stocks and told him to live off the dividends. The problem was the dividends only generated about $6,000 per year. Harold was slowly eating into his principal, watching his nest egg shrink year after year. He was terrified he would run out of money before he ran out of life. One day, Harold came to me and asked for help. He said, "Warren, I did everything right. I saved my money. I invested in good companies, and I am still struggling to make ends meet. What am I doing wrong?" And reached his portfolio. I saw the problem immediately. Harold was invested like a young person trying to grow wealth, but he was a retiree who needed income. Those are two completely different objectives that require completely different strategies. I spent an afternoon with Harold restructuring his approach. I did not put him in risky investments. I did not tell him to speculate. I simply showed him how to squeeze more income out of every dollar he owned within 6 months. Harold had nearly tripled his annual income without taking on significantly more risk. He lived comfortably for another 22 years and left money to his grandchildren when he passed. That experience taught me that most retirees are not struggling because they do not have enough money. They are struggling because they are using the wrong strategies to generate income from the money they have. So let me share with you the framework I would use to turn $250,000 into $80,000 of annual income. This is not a get-rich-quick scheme. This is not speculation. This is a systematic approach that combines multiple income streams, each one building on the others, creating a retirement income machine that can sustain you for decades. The framework has 5 components. First is what I call the dividend foundation. This is the bedrock of reliable growing income that you can count on no matter what the market does. Second is the covered call accelerator. This is how you extract additional income from stocks you already own, sometimes doubling or tripling your dividend yield. Third is the high yield allocation. This is a carefully selected portion of your portfolio dedicated to higher yielding investments that most advisors are too scared to recommend. Fourth is the strategic principal access strategy. This is understanding when and how to use your principal as a tool rather than treating it as something sacred that can never be touched. And fifth is the income stacking method. This is how you layer all these strategies together so they compound and reinforce each other. Now let me break down each component in detail because the devil is in the details. And if you get these details wrong, you will end up like Harold before I helped him, generating a fraction of the income you could be earning. Let us start with the dividend foundation. Most people think they understand dividend investing. They buy a few blue chip stocks, collect their 2 or 3% yield, and call it a day. But that approach will never generate the income levels we are talking about. When I look for dividend investments, I am not just looking at current yield. I am looking at 5 specific factors that determine whether a dividend stock will actually deliver the income you need. Factor 1 is yield sustainability. A high yield means nothing if the company cannot maintain it. I have seen countless investors chase 8, 9, 10% yields only to watch those dividends get cut in half. You need to look at the payout ratio. That is the percentage of earnings the company pays out as dividends. Anything over 80% makes me nervous. Anything over 100% means they are paying dividends from borrowed money or depleting reserves. That is a red flag. I want payout ratios between 40 and 70%. That gives the company room to maintain and grow the dividend even during tough economic times. Factor 2 is dividend growth history. A company that has increased its dividend every year for 25 years is telling you something important. It is telling you that management prioritizes returning cash to shareholders. It is telling you the business model generates reliable cash flow. It is telling you that even during recessions and market crashes, this company found a way to keep rewarding its owners. These are called dividend aristocrats, and they should form the core of your income portfolio. Factor 3 is business durability. I want to own companies that will still be generating cash 50 years from now. That means avoiding companies in disrupted industries, companies with heavy debt loads, companies dependent on a single product or customer. I want boring businesses, utilities, consumer staples, healthcare insurance. These are not exciting. But excitement is not what we are looking for. We are looking for reliable income. Factor 4 is valuation. Even the best dividend stock is a bad investment. If you pay too much for it, when you overpay, your yield is lower and your potential for capital appreciation disappears. I want to buy dividend stocks when they are trading below their historical average valuation. This usually happens during market corrections when everyone is panicking. That is when you load up factor 5 as tax efficiency. If you are over 60, you are probably in a lower tax bracket than you were during your peak earning years, but you still need to think about taxes. Qualified dividends are taxed at lower rates than ordinary income. Some investments like municipal bonds generate tax-free income. Real estate investment trusts often pay non-qualified dividends that are taxed at ordinary rates. You need to structure your portfolio to minimize the tax bite on your income. No for the dividend foundation portion of your $250,000. I would allocate about $100,000 at a conservative 4% average yield that generates $4,000 per year in dividend income. But here is the key. I would not just buy end holes. I would actively manage this portion by reinvesting dividends when prices are low and taking cash when prices are high. Over time, this approach can increase your effective yield significantly. Let me tell you specifically what I would own. I would put about $40,000 into a basket of dividend aristocrats. Companies like Procter & Gamble, Johnson & Johnson, Coca-Cola, PepsiCo. These companies have raised their dividends for decades. They yield between 2.5 and 3.5%, not exciting, but rock solid. I would put another $30,000 into higher yielding utilities and REITs. Companies like Duke Energy, Southern Company, Realty Income, National Retail Properties. These yield between 4 and 6%. And I would put the remaining $30,000 into high-quality closed-end funds that focus on dividend stocks. These funds often trade at discounts to their net asset value and can yield 7 to 9% through a combination of dividends and return of capital. That $100,000 allocation now generates roughly $5,000 to $6,000 per year in dividend income. Not $80,000, but we are just getting started. Now let us talk about the covered call accelerator. This is where we start to multiply our income. A covered call is when you own 100 shares of a stock and you sell someone the right to buy those shares from you at a certain price by a certain date. They pay you a premium for that, right? If the stock stays below that price, you keep the premium in your shares. If it goes above, they buy your shares at the agreed price, and you still keep the premium. This strategy is not speculation. It is income generation, and it can dramatically increase the yield on stocks you already own. Let me give you a specific example. Say you own 100 shares of a dividend stock trading at $50 per S. Here, that is $5,000 invested. The stock pays a 2% dividend, so you receive $100 per year in dividends. But now let us add covered calls. You sell a call option with a strike price of $55 that expires in 1 month. The buyer pays you $1 per S share, or $100 total for the right to buy your shares at $55. If the stock stays below $55, you keep your $100 in your shares. You can do this again next month. And the month after that, over a year, you might generate an additional $1,000 to $1,200 from covered calls on that same $5,000 position. That is a 20 to 24% additional yield on top of your 2% dividend. Your total yield is now 22 to 26%. Now you might be thinking, what if the stock goes above $55 and they take my shares? That is a valid concern, but think about it this way. You bought the stock at $50. You received dividends. You received premium from selling calls, and now you are selling at $55. You made money in 3 different ways. You can take that cash and buy another dividend stock and start the process again. The key to successful covered call selling is picking the right strike prices and expiration dates. I like to sell calls that are 5 to 10% above the current stock price, with expiration dates about 30 to 45 days out. This gives you good premium income while reducing the chance of having your shares called away for covered call purposes. I would allocate about $50,000 of our $250,000 portfolio. This would be in stocks that have options available with good liquidity. Large cap dividend stocks work best. Apple, Microsoft, Bank of America, and Ant Verizon. These have active options markets with tight spreads. At a conservative 10% additional annual yield from covered calls, that $50,000 allocation generates an additional $5,000 per year combined with the dividends on those same shares. You are looking at $7,000 to $8,000 from this portion of the portfolio. Now let us talk about the high yield allocation. This is where most financial advisors get scared. They will tell you that anything yielding more than 5 or 6% is too risky. They are wrong. What is risky is not understanding what you own. When you understand the mechanics of high yield investments, you can generate significant income with manageable risk. There are 3 categories of high yield investments I would consider. First is business development companies, or BDCs. These are companies that lend money to small and medium-sized businesses. They are required to pay out 90% of their income as dividends. Many yield between 8 and 12%. The best BDCs have experienced management teams, diversified loan portfolios, and strong credit underwriting. Companies like Main Street Capital, Ares Capital, and Hercules Capital have track records spanning multiple economic cycles. Second is preferred stocks. These are hybrid securities that combine features of stocks and bonds. They pay fixed dividends that are usually higher than common stock dividends, but lower than junk bond yields. Many preferred stocks yield between 5 and 7%. They are senior to common stock in the capital structure, meaning if the company gets into trouble, preferred shareholders get paid before common shareholders are paid. Third is closed-end funds focused on income. These funds invest in bonds, loans, and other income-producing assets. Many use leverage to boost yields. The best ones are managed by experienced teams with long track records. Funds from PIMCO, BlackRock, and Nuveen often yield between 7 and 10%. The key is buying them when they trade at discounts to their net asset value for the high yield allocation. I would dedicate about $60,000 at an average yield of 8% that generates $4,800 per year. But I would be very selective. I would spread this across at least 10 different holdings to manage risk, and I would avoid anything with a yield above 12% when yields get that high. It usually means the market is pricing in a dividend cut so far. We have the Dividend Foundation generating $6,000, the Covered Call Accelerator generating $7,000, and the High Yield Allocation generating nearly $5,000. That is $18,000 per year from our first three strategies. Good progress, but we are not at $80,000 yet. This is where we need to talk about the Strategic Principal Access strategy. Most financial advisors treat your principal as sacred. They tell you, never touch it, just live off the income it generates. This is bad advice for most retirees. Here is why. When you retire at 60, you might live another 30 or 35 years, but you might also live only 15 or 20 years. Nobody knows. If you die with most of your principal intact, you essentially oversaved and underlived. You sacrificed experiences, comfort, and quality of life to leave money to heirs who might not need it. The optimal strategy is to gradually draw down your principal over your expected lifetime while maintaining a safety buffer for longevity risk. The 4% rule is a good starting point. It says you can withdraw 4% of your portfolio each year, adjusted for inflation, and have a high probability of not running out of money over 30 years. But the 4% rule was designed for traditional portfolios. When you are implementing the income strategies I am describing, you can often support a higher withdrawal rate because you are generating more income relative to your principal. For our purposes, I would allocate about $40,000 to a strategic access fund. This is money you can draw from to supplement your income when needed. At a 6% annual draw rate, that provides $2,400 per year. But here is the key. You only access this money when your other income sources fall short. In good years, when dividends are up and your covered calls are generating extra income, you leave this money alone and let it grow. Now we are at about $20,000 in annual income. Still not $80,000. This is where the income stacking method becomes critical. Income stacking is about layering multiple income strategies on top of each other so they compound. It is about using the same dollar to generate income in multiple ways simultaneously. Let me show you how this works. Take that $100,000 in your dividend foundation. Those stocks are also candidates for covered calls. By selling calls on dividend stocks, you are generating income from the same shares in two ways. Your $50,000 covered call allocation is already doing this, but we can apply the same thinking to other portions of the portfolio. Your high yield allocation of $60,000 includes closed-end funds. Many of these funds themselves use covered call strategies or leverage to boost income, so you are getting the benefit of professional management implementing these same techniques at the fund level. But here is where things get really interesting. Social Security optimization. If you are over 60, you have access to or will soon have access to Social Security benefits. When you claim and how you claim can make a difference of hundreds of thousands of dollars over your lifetime. If you can delay claiming until age 70, your benefit will be 77% higher than if you claimed at 62. That is an 8% guaranteed return for every year you delay for many retirees. The optimal strategy is to use their investment portfolio to bridge the gap between retirement and age 70. You draw more heavily from your portfolio in your 60s, then dramatically reduce your withdrawals when you start collecting maximum Social Security benefits. This approach actually improves your overall retirement security because Social Security is inflation adjusted and lasts for life. Let us say your Social Security benefit at 70 will be $36,000 per year. If you have a spouse with their own benefit or spousal benefit, you might be looking at $50,000 to $60,000 per year in Social Security income. That is not coming from your $250,000 per year, but it is absolutely part of your $80,000 income target. So let us stack all these income sources together. Dividend Foundation generates $6,000. Covered call premium generates $7,000. High yield investments generate $5,000. Strategic Principal Access provides $2,400. Social Security for you and potentially a spouse provides $40,000 to $50,000. That brings your total annual income to $60,000 to $70,000. We are getting close, but we are not quite at $80,000. Here is where we need to think about additional income optimization strategies. First is tax loss harvesting. Throughout the year, you will have some investments that decline in value. By strategically selling these at a loss and immediately buying similar but not identical investments, you can generate tax losses that offset your income. This effectively increases your after-tax income by reducing your tax bill. Second is asset location optimization, where you hold your investments matters for taxes. High-yield investments that generate ordinary income should be in tax-advantaged accounts, like IRAs. Dividend stocks that pay qualified dividends can be in taxable accounts. Municipal bonds that pay tax-free interest should be in taxable accounts. Getting this right can save you thousands of dollars per year in taxes. Third is income timing flexibility. In some years, you might need more income, in other years, less. By having multiple income streams, you can turn on and off. You have flexibility to match your income to your needs. Need extra cash for a major expense, sell some additional covered calls, or take a larger distribution from your strategic access fund. Having a low income year, keep more money invested and let it compound. Fourth is the healthcare optimization angle. If you are between 60 and 65, you are not yet eligible for Medicare. Health insurance can cost $20,000 to $30,000 per year for a couple, but if you can manage your income to qualify for Affordable Care Act subsidies, you might reduce that cost dramatically. This is essentially additional income because it is money you do not have to spend. Let me tell you about another retired couple I advised several years ago. Tom and Margaret had about $300,000 saved and were struggling to make ends meet. They were generating about $12,000 per year in investment income and taking an additional $15,000 from principal. Their total income was $27,000, which barely covered their expenses. I helped them restructure using these same principles. We moved from a traditional portfolio to an income-focused portfolio. We implemented covered calls. We optimized their Social Security timing. We managed their income to qualify for health care subsidies. Within 2 years, their total income, including Social Security, had increased to over $70,000. They were traveling, enjoying their grandchildren, and no longer worried about running out of money. The point is not that everyone can generate $80,000 from $250,000. The point is that with the right strategies, you can generate far more income than traditional approaches would suggest. And for many retirees, that additional income makes the difference between a comfortable retirement and a stressful one. Now, let me address some concerns you might have. You might be thinking this sounds complicated. It is more complex than just buying an index fund and hoping for the best. But it is not rocket science. These are strategies that individual investors have been using successfully for decades. If you can balance a checkbook and follow instructions, you can implement these strategies. You might be thinking this sounds risky. Every investment involves risk. But these strategies are designed to generate income, not chase growth. The risk is actually lower than trying to grow your portfolio aggressively in retirement because you are not dependent on market appreciation to fund your lifestyle. You might be thinking, I do not have $250,000. These strategies scale. If you have $100,000, you can implement the same framework at a smaller scale. The percentages and yields work the same. You just generate proportionally less income. You might be thinking, I am older than 60 or younger than 60. Does this still apply? Absolutely. If you are older, you might lean more heavily on the strategic principal access because you have fewer years to fund. If you are younger, you might keep more in growth assets and phase into income strategies over time. Let me give you a practical implementation roadmap. Month 1, Assess your current situation. How much do you have saved? What is your current income? What are your expenses? What is your Social Security situation? Month 2, establish your dividend foundation. Start moving assets into dividend aristocrats, high-yield utilities, and income-focused closed-end funds. Month 3, begin covered call selling. Start small. Sell calls on just a few hundred shares to learn the mechanics. Month 4, add high-yield investments. Carefully research BDCs, preferred stocks, and additional closed-end funds. Month 5, optimize your Social Security strategy. Use an online calculator or work with a fee-only financial advisor to determine your optimal claiming strategy. Month 6, implement tax optimization, review asset location, look for tax loss harvesting opportunities, consider healthcare subsidy qualification. By month 6, you should have a fully functioning retirement income machine, but do not stop there. Review your portfolio quarterly, adjust your covered call strikes based on market conditions, reinvest dividends during market pullbacks, stay flexible and responsive. I want to leave you with a few final thoughts. Retirement income is not about finding the one perfect investment. It is about building a system that generates income from multiple sources, each one complementing the others. When dividends are covered, call premium can pick up the slack. When the market is volatile, your high-yield investments provide stability. When you need extra cash, your strategic access fund is there. This approach requires more involvement than simply handing your money to a financial advisor and hoping for the best. But that involvement is actually a feature, not a bug. Staying engaged with your finances keeps your mind sharp. It gives you a sense of control over your retirement, and it often generates better results than passive approaches. I have seen too many retirees hand over their life savings to advisors who put them in cookie-cutter portfolios designed to minimize the advisor's liability rather than maximize the client's income. Those portfolios generate 2 or 3% yields when retirees need 6 or 8%. The retirees slowly deplete their savings, become increasingly anxious, and eventually find themselves in financial difficulty. You do not have to be one of them. The strategies I have outlined today are not secrets known only to Wall Street insiders. They are techniques that any motivated investor can learn and implement. They just require effort, discipline, and a willingness to think differently about retirement income. When I look back at my career, some of my most satisfying moments have not been the big deals or the famous investments. They have been moments like helping Harold the railroad worker restructure his portfolio so he could enjoy his final decades without financial stress, like showing Tom and Margaret that they could more than double their retirement income with the right strategies, like teaching everyday people that they have more control over their financial destiny than they ever imagined. That is what I hope I have done for you today, not giving you a magic formula that guarantees $80,000 in income, but showing you a framework, a way of thinking about retirement income that can dramatically improve your financial situation. The specific numbers will vary based on your circumstances, but the principles are universal. Generate income from multiple sources. Use strategies like covered calls to squeeze more income from assets you already own. Be thoughtful about principal access rather than treating it as forbidden. Stack your income streams so they compound and reinforce each other. If you are over 60 and worried about retirement income, there is hope. You are not stuck with whatever your current portfolio generates. You have options, you have strategies available to you, and with effort and discipline, you can build the retirement income you need to live comfortably for the rest of your life. Let me share one more critical concept that ties everything together. The income floor strategy. This is how you build unshakable confidence in your retirement, the kind of confidence that lets you sleep at night no matter what the market does. The income floor is the minimum amount of income you absolutely must have to cover your essential expenses. Housing, food, healthcare, utilities, basic transportation for most retirees. This number is somewhere between $40,000 and $60,000 per year. Everything above that is discretionary. Travel, entertainment, gifts, dining out. The key insight is that your income floor should come from the most reliable sources. Social Security is at the top because it is guaranteed by the government and adjusted for inflation. Next come high-quality dividend stocks with decades of uninterrupted payments. Then come bonds and preferred stocks with strong credit ratings. These sources form your income floor. Your discretionary income can come from less certain sources. Covered call premium varies with market conditions. High-yield investments can cut dividends. Principal access depends on your portfolio value. These are fine for funding vacations and nice to have expenses, because if they fall short in any given year, you can simply cut back on discretionary spending. When you structure your income this way, you never have to worry about covering the basics. Your floor is secure. The only question is how much extra you have for the good stuff. And that question is a lot less stressful than wondering whether you can pay your electric bill. I learned this lesson the hard way watching investors in the 1970s. Inflation was raging. The stock market was in shambles. Investors who depended on capital appreciation for their retirement income were devastated. They had to sell stocks at depressed prices just to buy groceries. They watched their nest egg shrink month after month with no end in sight. But investors who had built income floors based on dividends and Social Security fared much better. Yes, inflation eroded their purchasing power somewhat. Yes, their portfolios declined in value, but they did not have to sell at the worst possible time. They could sit tight, collect their dividends, and wait for the storm to pass. When the market recovered in the 1980s, they still had their shares. They participated in the recovery. The panic sellers did not. This is why I emphasize income generation over total return for retirees. Total return looks great on paper, but it does not pay your bills. Income pays your bills, and when you have reliable income, you have the staying power to weather and the market condition. Let me also address what I call the widow and widower problem in most couples. One spouse handles the finances, the other spouse knows the basics, but has not been deeply involved. When the financially savvy spouse dies, the surviving spouse is suddenly thrust into managing everything, often at the worst possible time while grieving and under stress. The strategies I have outlined today are designed to be maintainable by someone who is not a financial expert. Dividend stocks pay you automatically. Social Security arrives every month without any action required. Covered calls require some attention, but you can scale back or eliminate them if needed without destroying your income. Compare this to complex strategies involving options, spreads, futures, contracts, or active trading. Those strategies might generate higher returns, but they require constant attention and expertise. They are not widow and widower friendly when designing your retirement income strategy. Always ask yourself whether your spouse could maintain it if you were gone tomorrow. Another consideration is inflation protection. Over a 20 or 30-year retirement, inflation will significantly erode your purchasing power. $1 today might only buy 50 cents worth of goods in 20 years. Your income strategy needs to account for this. Social Security is automatically adjusted for inflation. Dividend stocks tend to increase their payments over time, often faster than inflation. Companies like Procter & Gamble and Johnson & Johnson have raised their dividends every year for decades. Over time, those increases compound and your dividend income grows. Covered call income does not have built-in inflation protection, but it tends to increase with stock prices as stock prices rise with inflation. The premiums you collect from selling calls also rise. High-yield investments are more variable. Some have inflation protection built in, others do not. The key is building a portfolio where the majority of your income comes from sources that grow over time. This is another argument for the dividend foundation approach. Yes, the current yield might be lower than some alternatives, but if your dividends grow at 6 or 7% per year, you are significantly outpacing inflation, and your standard of living improves over time rather than declines. I want to address one more common mistake. Many retirees dramatically underestimate how long they will live. The average 60-year-old today has a roughly 50% chance of living past 85, 1, and 4. We'll make it past 90. And these numbers improve every year as medical technology advances. If you retire at 60 and plan for a 20-year retirement, you have a significant chance of running out of money. This is called longevity risk, and it is one of the biggest threats to retirement security. The strategies I have outlined help address this risk in several ways. First, Social Security provides lifetime income. No matter how long you live, those checks keep coming. By delaying to age 70, you maximize this guaranteed lifetime income stream. Second, dividends are sustainable indefinitely. As long as you own the stocks and the companies keep paying, you receive income. You do not deplete your principal by collecting dividends the way you would by selling shares. Third, covered calls can be maintained indefinitely. There is no expiration date on this strategy. As long as you own shares and options markets exist, you can generate premium income. Fourth, the strategic principal access portion is designed to be depleted over time, but it is only a small portion of your total portfolio. And by the time it is depleted, your Social Security income has typically increased substantially due to inflation adjustments. Compare this to the traditional approach of accumulating a nest egg and drawing it down over time. Under that model, you are always watching your balance decline. You are always worried about running out. You are always doing mental math about whether your money will last. That is a terrible way to spend your retirement years. The income machine approach gives you peace of mind. Your income is largely independent of your portfolio value. Yes, the value fluctuates, but your dividend checks still arrive. Your Social Security still deposits. Your covered call premiums still accumulate. You stop obsessing over your net worth and start enjoying your retirement. Let me give you one final piece of practical advice. Start small and build gradually. Do not try to implement everything I have discussed in a single week. These strategies require learning, practice, and refinement. Start with the dividend foundation. Spend a few months building your portfolio of high-quality dividend stocks. Learn how they behave. Understand the rhythm of dividend payment dates and declaration dates. Then add covered calls. Start with just 100 shares of one stock. Sell one contract. Learn the mechanics of options. See what happens when the stock goes up, goes down, stays flat. Make mistakes while the stakes are low. Then add high-yield investments, research BDCs and preferred stocks. Understand the risks. Start with small positions and build as your confidence grows. Then optimize Social Security. Run the calculations. Consider different claiming strategies. Understand how your decisions affect your lifetime benefits. Then put it all together. Stack your income streams. Optimize your taxes. Build your income floor. This process might take 6 months to a year. That is fine. Better to build slowly and correctly than rush and make expensive mistakes. That is what I would do with $250,000 if I were starting over at 60. Not chase the next hot stock, not gamble on cryptocurrency, not hand my money to an advisor who does not understand income strategies. I would build a retirement income machine using the principles I have shared with you today, and I would sleep well at night knowing that machine would keep generating income year after year through good markets and bad, for as long as I need it to.